when you start to expose people to the idea of passive income, people realize that it fits their lifestyle, that everybody nowadays is busy, and if you can grow your investments in a tax preferred way where you have an active person who's managing it, who you know that you have a relationship with, that you can call on the phone, um, a lot of people are very comfortable with that, and it's a great service that syndicators and other people are doing, offering that to the public. We're helping people chart their own financial course.
Welcome to the Ask Me How I Know podcast. I'm so grateful you are here joining me for this amazing episode. You hear me say that every single time because, my goodness, I am so blessed to have the most amazing guests. But today I am really especially grateful because I get to have not just a guest, but also a friend in the investment community. So I want everyone to please welcome Daniel to Ask Me How I Know. Daniel, thank you for joining me.
Julie, it's great to be here.
I love what you're doing. You do so much in the investment space, but even like you reach far beyond the investment space. I just want to say, I love what you're doing, in life in general, but people don't know anything about you. So if you don't mind, just give us a brief introduction about who are you and what do you do?
Sure. Well, my name is Daniel Holmlund. I'm the founder of Good Samaritan Capital, which is a real estate investment firm that invests in commercial real estate assets. This year, we are currently invested in 1,499 doors. And so we've got quite a few assets that we're currently managing, and we reach out to partners who join with us on this, both on the active side and the passive side. But just in addition to that, I feel that real estate investing for me is a way to it's a mechanism for me to work on my own personal growth and to help other people work on their personal growth. It takes a lot of discipline, a lot of communication, a lot of teamwork to do these sorts of things. And it also helps you become a better person as you grow. And as you grow, of course, your ability to invest or to do whatever it is that you're doing grows as well. I just happen to choose real estate investing because I'm passionate about it and I love it. But if it's gardening or languages or whatever it happens to be, I think you should be investing in yourself so that you can grow and help other people grow around you.
And that's exactly what you do. In fact, we were talking off air, just some of the ways that you were supporting other people just via your mastermind group so that they can, really truly be empowered. And that's one thing that I love, not just like you were mentioning, it's not just about the real estate niche. It's, when people are pursuing growth and development, it just ripples out to the people around them.
Yeah, absolutely. If and I love to talk to people about real estate or other topics. I maintain open office hours for people that I know, and for people on your podcast. I'd be glad to give that link out as well. It's a 15-minute call, and you just call and set the topic. But in any respect, real estate for me has been a way that I've been able to start to build my own passive income, start to help my family grow in their ability to have passive income, and to a certain extent too, I enjoy it because it's a way of controlling my own financial future. I don't necessarily have to be dependent on a job, even though I choose to be at a job right now because I really enjoy my job. But we'll see how long that lasts. Real estate is becoming a larger and bigger portion of my life as we speak.
Well, right. And you do work with a lot of really wonderful people. It seems, from what I can tell, it seems like a really great space. So Daniel, we were talking about the direction we want to take this conversation. And you know what, listeners, I want you to know, one, Daniel has his own podcast. So we'll drop links and everything there in the show notes. But so you want to go check out his podcast. I'm just going to put that out there, number one right now. But by being content creators, we're always keeping our listeners, that's you, in mind as we're, hey, what should we talk about? What would help our listeners? And Daniel threw this idea out there and I thought, wow, we've spoken on these topics. I've had guests speak on these topics, but they're kind of scattered. And so we're going to create this like anchor episode for you. And we're going to just go through different asset classes, different ways you can invest in real estate, kind of the pros, the cons, and then we'll talk about maybe some of the tax advantages or disadvantages that you might find. And this is going to be one of those waypoints for you as you are going in your investment, on your investment journey. You can come back and reference this and say, like, what was that one? And I'm not going to give them all away right now. So you're going to have to listen to get all of these amazing, different asset classes that you can invest in and why you would or would not choose to do that. So Daniel, I'm super jazzed.
All right, let's go to it. One of the things that I realized, I run a real estate investment club at my place of work, and I did a poll there when it was just initially starting. And one of the things that I asked them, what sort of real estate investment topics are you interested in talking about? And this is a conversation that I usually bring up with people because a lot of people are used to investing in stocks, in traditional Wall Street investments. And, they're very comfortable with giving their money to somebody else who they've never met, they don't have a relationship with, that is, sitting somewhere else, who's taking whatever fees they happen to be taking.
They don't even know the fees most of the time.
They don't even know the
fees. People don't know what the fees are.
I have looked at the prospectuses for mutual funds, and I feel like my eyes go sore looking at them. But anyway, we took this survey, and in our particular real estate club, about 70% of the people were interested in single family rental homes. And about 16 to 17% in between there were interested in passive syndications or commercial assets that you passively invest in. And that actually, first of all, I was kind of struck that 17% of the people actually knew about that. I think I maybe
the same thing.
Yeah, I might have done one or two talks before that survey that got people onto that.
Influenced them a little bit.
Right. But 1 year later, a lot of people realized that there's a lot of different ways that you can participate in real estate. You can be completely passive, completely active. You can participate in tax-advantaged real estate transactions and real estate transactions that are not tax-advantaged. There's a lot of different spectrums because real estate is a multidimensional asset. And 1 year later, when we redid that same quiz, we had a lot of people come to the conclusion. Now, these people were busy people. They had full-time jobs, and they had come to the conclusion that passively investing fit their lifestyle better than actively investing. Although a lot of people are very devoted to actively investing. They love purchasing, their single-family home or duplex, triplex, whatever it happens to be, and running it themselves. A lot of people get a lot of joy out of that, and I actually enjoy being active too. But the second poll that was taken a year later, we had 60% of the people said that they were interested in passive investments. And we also had a similar number for active investments. So a large growth in the number of people. So what I'm trying to say here is that when you start to expose people to the idea of passive income, people realize that it fits their lifestyle, that everybody nowadays is busy, and if you can grow your investments in a tax preferred way where you have an active person who's managing it, who that you have a relationship with, that you can call on the phone, a lot of people are very comfortable with that, and it's a great service that syndicators and other people are doing, offering that to the public. We're helping people chart their own financial course.
And when we say syndicators, since we're going to make this kind of an anchor episode, we're talking about the people that are organizing the actual real estate acquisition or purchase, and they are going to be managing it and running it. And remember, syndication is just a fancy way of saying a bunch of people pooling their money together to do something larger than themselves.
Yep. Usually, like in the properties that we do, we usually have anywhere from 30 to 50 passive investors, and they provide the capital. We provide the expertise and the management and the sweat equity. And we also put our money in as well, of course. But it's a good partnership because it takes a lot of time to become very experienced or to become experienced enough that you can purchase a building and operate it having other people depending on you for their investment. That's a huge responsibility, and it takes time to get to a point where you know the business well enough to do that.
Right, and you're not going to lose the money.
Absolutely,
right.
yeah.
Right.
Yeah,
definitely.
Capital preservation is number one. And let me tell you a story. So when back in 2002, 2003, I was actually a trader at the Chicago Board of Trade. I stood in the 10-year bond pit and I flashed hand signals, sell 50, buy 5, sell 20, whatever it happened to be. And it was extraordinarily high stress. You're sitting there watching the ticker, and every time that the bond market moves in what are called ticks, which are 31 and a quarter dollars, and the minimum movement is a half tick. And so when you buy 100 bonds and the minimum movement is a half tick, that is $16 or so. And if you buy 10 of them, it's $160. And so you're watching your money go up and down like this. And I think ever since then, I've been on a quest. And I saw how many people were completely stressed out and broken, and unfortunately, doing substances in order to keep up with the stress. Ever since then, I've been moving more and more towards predictability and scalability, and being able to create investments that have cash flows that you can calculate in advance. And so that's the main thing that I love about real estate over stocks, over Bitcoin, is that I have a 5-year cash flow projection for, all of my properties. And I don't have a 5-year, I don't even have a 1-day cash projection on Bitcoin.
I was just going to say, I love that. There are investments that I love, but, and I have my Bitcoin, but, you don't know what's going to happen with it. And you don't know what's going to happen with the stock market.
It's true.
And you have zero control. This is where I always say the lack of control on those assets just kind of drives me a little bit batty, because it's like, at least in real estate, especially when we're talking about commercial real estate assets, we have a control over our value of that asset. And I don't have to worry about, the neighbor next door crashing, the comparables for my single family. I don't have to worry about that. Like if my team does their job the right way, we're going to be okay.
Mm-hmm. The other thing that I like not having to do is checking the stock market 5 times a day. I used to do that.
Only 5?
Yeah. Well, that's when the market's not, just normal. The market's doing something strange, which it often is nowadays. Right. You might be sitting there checking it every few minutes or every half hour or something like that. So I enjoy not having to stress about that as well.
Oh my goodness. That's, a big thing. Well, why would somebody want to go into single family? I mean, for me, I know what I hear from a lot of people, and this is what initially was one of the things we gravitated towards, was cash flow. It's like, well, single family, we can have this cash flow. And then I can think of all the reasons why. Y'all have heard me say all the reasons why I don't prefer single family. But, let's talk about that single family.
Sure. Single family, first of all, that's what most people know. I mean, when most people hear real estate investing, they're thinking about buying a rental home. And that is the most natural thing. It is the oldest investment in all of human history, right? Renting a home out next to your, for your neighbor. It's as old as time. And it's the most time-tested real estate investment strategy that there is. And so a lot of people, if they're maybe newer investors, that's the first thing that pops to their mind. Mm-hmm. And I think that's completely natural. In a group where I'm in, I know a lot of high tech people and engineers, and they tend to be the type of person that likes to do everything themselves, as I used to be, and I've broken a lot of those habits mostly through a lot of work. But people like single family homes because they understand it, and it's something their friends and family are doing, and it's something that they can talk about with other people. And so when you have a real estate investment club, a lot of people talk about single family homes. And so when I look at different real estate strategies, I like to evaluate them on the return on investment. How much money are they going to make? What sort of cash flow they're going to make? How much effort it is, or how much sweat equity do I need to put into the property?
How active do I need to be in this? Really?
Yeah. How active do I have to be? Because and we're going to hit each of these, and I'll tell you why I don't prefer single family homes. The other areas are, how much risk is there associated with the investment, both from a business plan and from a market risk perspective, and then how much cash does it require to get into the investment?
Mm-hmm.
How long's the holding period? Is it available to non-accredited investors? And is it tax advantaged? And so I think what we're going to go through here is we're going to look at a variety of different real estate strategies and just rank them along those and talk about them. Because that's one of the first conversations I tend to have with new real estate investors is, hey, everyone's different. You might be a person who wants to be completely passive. You might want to be completely active. You might be the type of person that doesn't want to pay Uncle Sam a dime. You might not care if you pay Uncle Sam. So people have different risk, different amounts of time, different amounts of liquidity. And so understanding what each of these real estate strategies are in terms of those is a great place for new investors to start. So let's start with single family homes.
Let's do that. Everybody knows single family homes.
All right. So single family homes, let's take the case of a turnkey property. So there are lots of groups out there that have turnkey rentals, and these are homes that are completely fixed up. They're in pristine condition. Oftentimes the people that are selling it to you also do the property management for them. And the advantage to doing this is it's a great place if you have money to just put your money and you'll receive a fairly solid return. It has tax advantages, and it's something that you can put capital in for capital preservation.
And it is pretty easy. You just go,
easy.
If you're listening, obviously you are listening, go back to the episode with Kevin Dugan. He has turnkey assets that he sells in the Chicago area. And so that's exactly what he does. And it just allows people to put their money to work. Boom. But let's talk about, is it worth it?
So let's talk about ROI. So ROI, in my opinion, takes into account not only your cash flow throughout the lifetime of the deal, but also the amount of equity that you receive when you sell it. And in the crazy market that we have nowadays, hey, last year nationwide we had a 21% jump in median home values nationwide.
So crazy.
21%. And in a lot of areas it was more, and in some areas it was less, right? So right now the Midwest and the Southeast are very on fire. Boise, some of the central western states, and the two coasts tend to be performing a little bit less currently because people are moving out of those areas into these areas. So when I quote ROI here, it's going to be different depending on year to year. And that's part of the problem with the single family home, is that it's hard to put an exact target on your ROI. So I have put down that it's a medium return. So somewhere between 5 to 12% often. Obviously in the crazy market that we have now, it's been more. In the past, historically, it's been more in that range. In terms of cash flow, this can vary quite a bit for a single family home. And it's one of the reasons why I don't like investing in single family homes, because if you've got a really good cash flowing deal, you might be making $300 or $400. You purchase the property in an area where the rent can cover your mortgage, and the mortgage provides and expenses and taxes and insurance. And once you've paid all of those things, you've got a few $100s that you can collect each month. And that's great. So you've got cash flows coming in. You've got an asset which is probably appreciating, as it does in most markets. But the problem is that you might have unexpected capital expenditures, which, in other words, for those that do single family homes, this is called the air conditioning breaks. Or the dishwasher breaks.
Or like our friends, they have an asset, and apparently they have to redo an entire leach field because a septic system needed it. So it's a pretty penny.
So unexpected expenses like that are a lot of investors don't tend to budget for that when it's a single family home. And in larger properties like multifamily properties, you have to bake that into the budget, just because Your risk is distributed across many other doors. So in a single family home, that risk may or may not hit you, but in a multifamily home, it will hit you to some extent, and you have to bake that into your business plan.
You're prepared
so it's
for
accounted for. You're prepared for it, right?
Yep.
All right, cash to start. In this case, you're putting a down payment on a home. It depends, 20% of the value is fairly common in order to avoid PMI. And the hold period is for as long as you want to hold it. It's open to non-accredited investors, meaning that if you are non-accredited, of course, you can buy a house. And it does have tax advantages. In fact, rental homes have pretty good tax advantages. You can depreciate them. You can engage in a 1031 exchange, which is where you defer your capital gains from one project to another. It has pretty good tax advantages. The hidden problem is that it's not very scalable. If you want to have, instead of $300 a month, you want to have $900 a month, well, now you're managing 3 properties instead of 1. And most people that I've talked to who are really interested in doing this tend to max out around, a dozen, 2 dozen properties. And that's about as many as you can handle. At that point, it becomes a full-time job.
And have you thrown in there if it's self-managed or managed with a property management company?
Yeah, I haven't talked about that. A management company for a single family home will run you in between 7% to 10% of your monthly income. And that is taken right off the top. A management company will protect you from a lot of the day-to-day things. And I actually highly encourage you get one, because they're going to know the laws in your area better than you will. So it's really,
they keep very nice records also.
And they keep great records.
They keep all your accounting all neat and straight, neat and tidy.
Yep. But don't be fooled into thinking that it's going to be no work for you, because you still have to approve all their expenditures. You have to deal with any unexpected situations. It's still work for you.
And you're still footing the bill. Something happens.
And you're footing the bill.
You're footing the bill.
Yeah, absolutely. And that is different than a commercial passive income. All right, let's go on to fix and flip properties. And I'm sure people have lots of questions. If you have questions, contact Julie. I'm sure she'll answer questions. Or you can refer them to me, either way.
Yeah.
All right.
Fix and flip just gives me a headache.
Yeah, there are a lot of people that are very into fix and flip. I would say that fix and flip is a strategy that you should use if you love doing fix and flips.
I know it's enticing to so many, because they're like, oh, I can make this like quick profit off of it. And they'll like leave their job and they'll be like, yeah, I'm going to do this because I can make, turn a great profit, and it's a really short time frame. But it's like you're always on the hunt for something for your next project. And if the market goes down, you're so exposed as with what's happening.
Yeah,
so many things. I can go on. I should let you talk.
Yeah, well, the upside to a fix and flip is the ROIs can be astronomically great. You might make 50% on your money in a half a year. You might make 100% on your money or more in a half year. The returns are very sizable. Now, the downfall of this is you do not get an asset to keep for the long term. So you're selling that asset usually in less than a year, which means you're paying long-term capital gains instead of short-term capital gains. And long-term capital gains are, of course, taxed at income rates. So if you are an investor, you're probably paying 30 to 40% tax on any sort of ROI that you get out of the project. So it is what I would say is it's not a tax advantaged method of investing in real estate. You have very high taxes.
And I will say, some friends learned that the hard way. So if you are considering a fix and flip, there's a lot to be considered. Like, yes, you can turn a quick profit. It might be substantial, but you will be giving a huge portion of that pie over to the government.
Yep. The hands-on effort is obviously, I put that in the high category. The risk, I also put that in the high category. You have to know what you're doing. You have to pay for that entire house or borrow the money for it, right? You're dependent on whatever the market does. So if during the middle of your renovation, the market changes, your business plan changes. So it's high risk, high capital. and high in terms of the amount of time. The benefit is it's a low holding period. You only have it for, I don't know if that's a benefit or not. Actually, I prefer to own forever.
I do too, because I don't want to have to go and repeat. It's very challenging to find a good asset, and then in fix and flip, it's very competitive. To find them. I sound like such a negative Nelly on the topic, but and I happen to know you and I both know people that are very successful with fix and flip. It's just that if you're trying to like have a job and have a side hustle type thing, this is exhausting.
It is exhausting.
I get exhausted just like thinking about it.
Now, the kind of the sister strategy to this is the Brrr Method, right? Mm-hmm. And this is where, let's see if I've got my acronyms right. It's buy, oh boy, I'm having trouble remembering what it is. Rehab, rent, repeat.
Refi.
Yeah, okay, so sometimes there's an extra R in there.
Mm-hmm. Yep. Get your money back at the higher after you've raised the value of it. And that to me would make more sense, because that's like a long term. I'm not just trying to turn a quick profit. And then you'd be tax advantaged, right?
You hold it for a long term period of time. So when you sell it, you're holding it, you're getting rent, so you have cash flow. When you sell it, you can do a 1031 exchange, move it to something else. You have a depreciation schedule where you can take depreciation off your taxes. So this is actually a pretty good way of getting into real estate for people. And you know what, Julie? If your Brrr actually had 100 units in it, you know what we call that?
An apartment complex.
Value add multifamily investing.
Right.
That's exactly what we're doing with large apartment complexes. We're buying them, we're fixing them, we're adding value. I'm sorry, back to the Brrr Method though. When you buy the house, it's a lot of work. It is high in terms of the amount of capital that you're going to have to put into it. It's obviously open to people who are non-accredited investors, which is good. Anybody can do it. And you hold it for a long period of time. When you're done, you'll refinance it in order to pull your cash out, or a large percentage of it out, and then you'll turn around and rent it out. Now, the really good benefit is the cash flow is great in these situations, because when you refi, that means that most of your money is out of the property. And you don't have to pay as large of a mortgage consequently. And that means there's a larger spread between your rent and your mortgage payment. So you've got great cash flow. And that is one of the great things. And you're building assets and building a portfolio that you carry with you into the future. So that's
the one part that I do like about that. If you're going to do fix and flip, just do the Brrr Method. So at least you're keeping it and you're doing something more with that asset.
Yeah, absolutely. And it is, honestly, if you want to get into multifamily syndications, having a portfolio of single family homes is the absolute best way to do it, because a lot of people that I know, it's becoming more and more common, are 1031 exchanging their single family homes into syndications. And that actually gives you all the benefits of somebody else managing it, but at the same time, you're deferring your capital gains. And so it's a super tax efficient way in order to get into a larger apartment complex. And if I had single family homes to do that with, I'd be doing that for every single deal.
Right. But now finding a syndication, this is interesting, because I know some sponsors, some syndicators do not always receive 1031 exchange money, because it adds a little bit more on, the documentation side and such. So let's talk about that for a moment.
Yeah. Not very many lawyers are drawing up the types of papers that are needed for syndications to accept 1031 money. And the reason why is that you have to set up several different legal entities. Usually when you're 1031 exchanging a home into a syndication, from the legal perspective, you're setting up a tenant in common agreement. And the reason why you need to do this is because the IRS says that in order for a 1031 exchange to be considered valid, you have to own real intangible property. You have to own a physical asset. And in the case of a apartment syndication, people are investing in shares of an LLC, which owns an asset. So you're actually buying a security of a LLC that owns an apartment complex. And the IRS and the SEC have said that changing a real property into a security is not valid for 1031 exchanges. And so you have to set up a legal structure that gives you the ability to change into a real property. And that's what tenant in common does. It comes from, English common law. And what it says is that even though there are multiple owners, you still own a real and substantial portion of that property. You are a complete owner. You're not a partial owner. You're a complete owner along with other people. And so the tenant in common structure is set up. One LLC will actually house the syndication with all the passive investors. And next to it, you'll have your tenant in common structure with the people that have 1031. And there's usually lots of legal agreements that go in between to discuss how you're going to do management, how you're going to resolve, differences between the two legal structures. But the syndication structure and the 1031 LLC are tenants in common together. And that adds legal work to it. And in fact, I've been told, and from my own experience, we actually accept 1031 exchanges into most of our properties. I think all but one, we've done that. It adds about $20,000 worth of extra legal fees to us on average. And yeah.
So do you have a minimum amount then that you'll receive in? Because that's where I know some sponsors will say if it's below $1 million, we're not dealing with it because it's not worth the headache.
Right. Our minimum is 500,000.
Okay.
And I've heard people go lower and higher. It just depends on what you want to accept.
Yeah.
But there's extra, legal work to do, and you want to make sure that it's worth your while to do it.
That's interesting. Okay, I'm curious. I'm curious about short-term rentals. They're smoking hot right now. Just everyone I'm talking to is almost the way fix and flips were in like circa 2011, 2012, and it's even still, but like everybody was doing it back then. And now I feel like everybody is in short-term rentals because it's such a cash cow.
Yeah. I mean, hey, we're in the middle of the 2019, 2020, 2021 pandemic,
right,
and ongoing, and people want a place to get away to, and it's causing short-term rentals. I've looked at short-term rentals, and my eyes have kind of popped when I've seen some of the prices. So it is a great way to get extra money out of your rental home. If it's in the right area, you've got to be near something that will attract a person to be there on a short-term basis. And that might be, it might be just you're in a resort area, it might be you're near a hospital and you have students that are doing residency, or a college and students are renting it. Whatever it happens to be, there are only certain areas that short-term rental works for. Now, the advantage to a short-term rental is obviously that you can double the amount of income that you're making potentially from a short-term rental. One of the downfalls of it, or the problems with it is that it may not necessarily be stable income. You might get a lot in one month and not so much in the next. The other thing is that the time that it takes is quite a bit higher. And a lot of people put many systems into place in order to reduce that complexity, but it definitely is more work to handle a short-term rental, because when people move out, you need to send the cleaning crew in to clean it up. You need to make sure that that it's fully furnished. That's an extra expense. And it looks great. There's a fair amount of work to do just in communication with the people that are going to be staying there. So it's definitely more work, but it's more reward.
And I'll throw in there your reputation. So you have to have like the reviews. You have to have people that are, loving where you're loving this property so that it's doing well. On an interesting side note, someone I'm acquainted with who's very successful in this, what he's done now is that he's taking the register from, Airbnb and the other short-term rental platforms. And now he's going back and is going to try to start just doing this on his own private party, so that he's reaching out to those people and booking them in advance on his own. So kind of getting rid of the middleman and creating this is where this family comes every single year for their family vacation.
True. Yeah.
Interesting.
Yeah. If somebody's a repeat customer, there's probably no reason to involve the third party if you can book them directly.
Right, right. Yeah,
Yep.
short-term. What about tax-wise?
Tax
How do you
wise,
see that?
it's got almost exactly the same profile as a turnkey rental property. It's an asset that you hold for long term. You can depreciate it. You can 1031 exchange it. And there are other tax advantages, of course, of having a business that owns and operates these in terms of business expenses. But it is a tax advantaged asset strategy. All right. Hey, yeah. Any other thoughts about Airbnb? We could go on a long time on Airbnb. I know an investor who his entire business model is he calls up people that have single family homes in an area that he likes and says, "How would you like to double your rent? And I'll manage it all for you. You know, just give me a cut of it." And he does this. He's got about 50 or so homes that he does this for now, and he's got a great little business going. Maybe a great medium-sized business going.
I'm wondering what the the projections are long term. What happens when life kind of resumes back to normal across the country? I don't know. Is it that people have now discovered short-term rentals, so they're not going to stay maybe at the resorts and the hotels as much because they prefer having the house because they're seeing the advantages? It'll be interesting to see how this plays out over the next couple of years.
Yeah, I suppose that your rental income is perhaps not as well defined as some of the other real estate strategies, and that definitely is a problem. Personally, I love short-term rentals. I'd rather do a short-term rental than a hotel any day. Hotels are like a business trip, right?
Yeah.
So I enjoy being a customer of it. I think we go maybe once or twice a year, usually around my anniversary, to escape somewhere fun and take advantage of short-term rentals. So I've got a soft spot for them.
I've got a soft spot for resorts.
Okay. You're the opposite. Okay.
Somebody else can do the cleaning and make the beds and keep it all neat and tidy, and it gives me a true break. I'm not worrying about cooking because we're just going to eat out.
Yeah. And that's the great thing about real estate too, is that the more you understand about it, the more you realize that there's real estate strategies that fit every personality and preference out there.
Yep.
And it is more effort to understand them all than going to the stock market and giving your money to a stockbroker. Although there's a lot that could be understood there too.
There is. Okay, so I was talking with a friend, and she's like, "I don't need to invest in apartments with you, Julie. We're invested in REITs. We have real estate holdings. We have a REIT."
Mm-hmm.
And interesting conversation, right, that we end up having about that. So let's talk about REITs, because a lot of people do think, well, I am invested in real estate.
Mm-hmm. Yeah, REITs are a great way to get into real estate quickly, to have a diversified set of assets that you're in, to have somebody else managing them. My big problem and we can go through those tenets that I sent out, those metrics that I mentioned before. The ROI on a REIT can be really good. You can have an 8 or 9, or it varies quite a bit, but you can have a medium-sized return on a REIT. They're dividend creating, which means that they'll throw off cash flow. They are low in terms of effort that you need to use. They are, say, medium in terms of risk. There's different risk depending on the REITs that you're involved in. Some are involved in, strictly retail, and some are doctor's offices. And so you can get it very specific in terms of the types of properties that you're targeting. So your risk can vary. The cash that you need to get started is low, right? You can buy one share of a REIT, and that might be, $50, $100, whatever it happens to be. The holding period is variable. You can get in and out. It's liquid. So it's sounding like a pretty good asset, right?
This is why I'm like, I know it sounds that way.
Well, so some of the drawbacks are that it's not a tax efficient asset, particularly if you're doing dividends, right? Mm-hmm. Those dividends are being taxed both at the REIT level, and then when they're passed through to you as income, they're being taxed at the income level. So you've got double taxation that's going on.
Oh my gosh.
One of the other things too, and really this This is the key reason why I don't invest in REITs. And it goes back to what I said originally about stocks is I don't know what its value is going to be tomorrow.
Yeah.
I can't create a cash flow projection based on a REIT. And as cash flow investors, what we're looking at is we're looking to create stable and predictable cash flow that we could use to plan a retirement, for example, right? And REITs, although they do give dividends and their dividends are higher than most stock dividends, they're not tax efficient with those dividends. And the majority of your ROI is not coming from your dividend, it's coming from the sale of the asset. So it is a lot of it will be subject to capital gains tax. You cannot 1031 exchange it. You cannot depreciate it. So it's not a tax efficient real estate class, and it's not predictable, at least in terms of creating a multi-year cash flow plan. So those are the main reasons why I avoid it. I like to have my portfolio in things that I can predict out over longer time horizons.
Yeah.
Yeah.
I'm with you on that. 100% with you.
Yeah. Any other thoughts there? I'm not as familiar with REITs as some of the other strategies, so there's probably points I'm missing and a lot of stuff to debate.
I think the most important thing for listeners is that you understand that a REIT does not have the advantages of owning the real estate yourself. I think that's just a really important distinction to make, because people kind of feel good. Oh, I own real estate. I'm in a REIT. No, you own a share. Okay, well, what's the difference then if I am invested, Julie, in your syndication, where I own essentially shares as a passive investor in your, in your syndication? Well, you're getting all the benefits of being an owner of real estate, of real tangible physical property, and of being sheltered business-wise. That now I'm not getting double taxed because the business entity that owns that is handing it off to you. It's not getting taxed multiple times.
It's tax advantage, and those advantages flow through to you.
Yeah, huge.
Yep. All right. What strategy do you want to go to next?
Well, let's see. We have just a few minutes left. I think, do you think we could tackle passive investing? Because we could probably talk about passive and active at the same time when we're talking about, larger syndications.
Yeah. I have quite a number of investors that come to me and say, Daniel, how can we be an active participant in your next project? And usually my answer is that the best, you need to learn this business first because you're responsible for other people's money. And the best way to do that is to be a limited partner first.
Yep.
And then put elbow grease into actually learning the business.
Yeah.
But being a limited partner is a good start.
Don't go out and buy an apartment complex just because, and with people like, no. You probably wouldn't just go start a tech company. You wouldn't just go start a pharmaceutical company. There's specialized business knowledge that goes into running these types of operations. And it takes a while to learn. It's not rocket science, though. Anybody can learn it. It just takes time. And you have to learn to work in teams, and you have to learn to be honest and transparent and to a fault, if possible. Be as honest and transparent as you possibly can, because this is what is going to allow you to communicate in a trustworthy manner. Yeah.
So passive investments, if we just go through those criteria, and I'm watching the time, you've got a pretty good ROI on passive investments. Many of the investments that we have dealt with have been in the range of in between 15 to 25% average annual return. And it differs from deal to deal, obviously. Oftentimes there's also cash flow, which comes off. It's very common right now in the industry to have 7 or 8 or 9% preferred return, which means that's cash flow that you get before the active general partners get anything. And then cash flow on some deals could be higher or lower, just depending on what the income and expenses are. But it tends to be around 8, 9, 10%, somewhere in that range. The hands-on effort is, of course, very low. From a legal perspective, the way that syndications are set up, the general partners are the managers of the LLC, and the limited partners are not non-managing members. And so, from a legal perspective, they actually do not, they cannot direct the investments. And that takes a lot of pressure off their plate because they're putting their investment into the hands of somebody who has already developed the business experience.
And you don't have to have any phone calls. Hey, what's your opinion on this? We want to, what should we do with unit, 21? Like, you're not part of any of that. Wow, right. What are we going to do with this resident? Like, none. You don't have to worry about any of it at all.
Although a lot of them do. I had an investor yesterday ask me why the water bill was the way it was. And you go through and you figure that out, and it turns out we were combining water and sewer into a single,
line item.
Yeah. And as soon as you say that, I go, oh, okay. Yeah. But so it's good to stay in touch with your investment, obviously.
Right. Right.
The cash to get started is about the same as a down payment on a home. So it's very common to have, $50,000, $75,000, $100,000 minimums in these types of investments, and which is roughly comparable to what you put down on a single family home. Mm-hmm. And the other advantage is that it's the biggest disadvantage. Let's go through taxes actually first, then we'll go to the disadvantages. It's a very tax advantaged way to invest. You can come in with a 1031 exchange if the syndicator supports that, but otherwise you're also getting all the depreciation benefits, and you're getting even additional benefits on top of that with cost segregation. That's a term you can Google. I'm not going to explain it right now, but cost segregation and bonus depreciation. So for me personally, the first investment that I ever did in multifamily, I put $75,000 into a 56 unit in Houston, Texas. Mm-hmm. And that year I received my K1 partnership return with $51,000 of depreciation on my $75,000 investment. And that we could do a whole talk on that, but that is incredible because it basically wipes out your cash flow taxes for the entire lifetime of the syndication. So it's a great way to invest. And yes, there is capital gains when it's sold, and you do need to be aware of that. But it's a very tax advantaged way of investing. Now, the major downside is that it's a non-liquid investment. You can't just call up your syndicator and say, hey, I need my 50 grand back, because that would require the syndicator to sell the apartment complex right. or refinance it. And so it's non-liquid. You're in for the duration of the business venture. And that's usually 4 to 7, 8 years, depending on the specific property. Yeah. So it's a long-term hold, and it's a way of building wealth in the long term. And it's something you should do with cash that you don't need immediately.
Definitely. And then at the sale of the property, there's quite often, if the business plan is executed well, there is a nice tailwind boost at the end, and that surge really gets to. I always think about it like this. If you can, double your money or close to that, now you can go and invest in 2 investments. And then from there, you can go take that money, and it's just multiplying itself out.
Yeah. In the stock world, there's a rule called the rule of 72. And it basically says, how many months does it take in order to double your investment? Well, the same rule actually applies fairly well to real estate syndications. You typically, depending on the deal, double your money in 4 to 7 years, something in that range. It's very common for our properties to have a 5-year time horizon in between 5 to 6 years to double your money, and it's a great way of creating cash flow to live on in the time while the business plan is executing, and then growing your nest egg with a snowball effect on the long term.
Yeah, super powerful. Wow, Daniel, this is fantastic information. I love how you're able to, you've created this ability. You have this ability, right? Where you're just breaking it and you're comparing apples to apples just by using the exact same metrics. And it provides so much clarity. And I have no doubt that this is helping listeners just understand, well, maybe I do want to get into short-term rentals. Here's the thing, it's real estate. It's super fun. There are
Mhm.
lots of ways to get involved, and one thing that I'm going to encourage everyone to do is, if you haven't listened to the episode with Neil Wahlgren, that's on industrial investing. And that's a whole nother investment space in the real estate. So, I mean, real estate has a ton of tentacles to it. And, if one doesn't work for you, there will be something that will work that will meet all of your needs. Daniel, thank you I just want to say how much I appreciate just all the care.
It's wonderful being here.
It's fantastic having you here. So what is the best way for people to reach out to you and I always remind people, if Daniel's resonating with you, remember, if you are not an accredited investor, you need to hop on the call. You need to schedule an introductory call so that you can be part of any type of offerings he has, just even looking at those offerings, right? So you can't look at them unless you have that phone call, because he can't put you on the investor list if you don't make that phone call. So make sure that you schedule that time if Daniel's resonating with you so that you aren't self-selecting out. So if they want to do that, what's the best place for them to go?
Just go to goodsamaritancapital.com, and there's a button there that says schedule a call with me. And I'm not only happy to talk about that, but if you have real estate questions, I love to talk real estate. I offer a free 15-minute call on any real estate topic.
It's funny because I think that any of us, like most of us in this niche, are just very much like, can we just talk about real estate all day long? It's fine. Just put me at a conference. I'll just talk about real estate all day long. This is great.
Yep.
Well, Daniel, thanks again for being here. And listeners, thank you for joining me once again. If you liked this episode, if you love this episode, please rate it 5 stars. Please make sure you drop a review. Let Daniel and I know what stood out to you and what's helping you shift that line mentally and with your investments. And remember, sharing is caring, and you don't know who needs this type of information. So make sure you share it out as well. Until next time, live big, love bigger, and go find your freedom. Thanks so much for joining me for another episode of Ask Me How I Know. This episode was brought to you by 3 Keys Investments. They are dedicated to helping people like you, you, my awesome listeners, develop passive income and legacy wealth through multifamily investing. Feel free to check out their website, 3keysinvestments.com, to see if there is an offering that will help your portfolio grow and meet all of your needs. If you haven't already rated, reviewed, subscribed, liked, all of those bells and whistles, I would be absolutely honored if you would do that for Ask Me How I Know. Thanks again, and go make it a great day.